We all know the snacks, but what about the stock? Today, we're going to look at a company you definitely recognize, Mondelez, but we're going to do it through the eyes of an investing legend. Yep, we're putting them to the Warren Buffett test. I mean, come on. Mondelez is the giant behind some of the world's most famous snacks. We're talking Oreos, Cadbury chocolate, Toblerone. You get the idea. These brands are pretty much everywhere. But here's the real question, the big one. Would the Oracle of Omaha himself, Warren Buffett, actually invest in this company? Well, that's what we're here to figure out. We're going to dive into the numbers and see if Mondelez has what it takes to be a classic Buffett-style pick. To do that, we're going to use a sort of simplified Buffett checklist. It's a really great way to cut through all the noise and just focus on what really matters when you're looking at a potential investment. This classic quote right here, this is basically our roadmap. It all boils down to two huge questions we need to answer. First, is Mondelez a wonderful company? And second, is it actually selling for a fair price? So let's tackle that first question. For Buffett, a wonderful company is one that's consistently profitable. It's got what he calls a durable competitive advantage. So how do we even begin to measure something like that?
Well, one of Buffett's favorite tools is something called return on equity, or ROE. Just think of it like a company's report card. It shows you how good management is at using your money, the shareholders' money, to make more money. A high, steady ROE, that's an A student right there.
So what's Mondelez's grade? Right now, its return on equity is 9.49%. But, a number by itself doesn't really tell us the whole story. We need some context. Is that good? Is it bad? And maybe more importantly, which direction is it heading? And here's where it starts to get pretty interesting. When we look at the trend, we see that while it's at 9.49% now, its average over the last 3 years was way higher, over 14%. This downward trend, that's our first big clue, maybe a little red flag that the company's profitability is getting a bit less efficient. Okay, on to our next checkpoint. A great business isn't just profitable, it's also growing, right? But we have to be really clear about what kind of growth we're looking for here. And this slide shows a really critical split. On the left, you've got the good news. People are definitely buying more snacks. Revenue's been growing at a solid 7.7% a year. But then you look to the right. The company's actual profit, the money it gets to keep, has been shrinking by over 7% a year over that same time. Whenever you see sales going up but profits going down, that is a major signal. It tells you that the cost of doing business is probably rising faster than sales, and that's squeezing those precious profit margins. This is exactly the kind of thing an investor like Buffett would zoom in on. So we've got a bit of a mixed bag on whether Mondelez is a wonderful company, but remember, that's only half the battle. Now we get to what is maybe the most important part of the Buffett check, the price. What's a fair price to pay for all this? To figure this out, analysts use a method called a discounted cash flow, or DCF analysis. It sounds complicated, but it's really just a way to figure out what a company's worth today based on all the cash it's expected to bring in, down the road. So after all the number crunching, this analysis spits out a fair value for one share of Mondelez, $54.26. This is our benchmark. This is our best guess at what the stock is really worth. So the whole game is about comparing that number to the price on the stock market. Remember Buffett's rule. We want a wonderful company at a fair price. So let's see what the market was actually asking for it. The last closing price was $57.71. So right away, you can see the market price is higher than our calculated fair value. And that difference brings us to another huge piece of Buffett's philosophy, the margin of safety. He always insists on buying a stock for a lot less than what he thinks it's actually worth. That discount is your buffer, your cushion, just in case you're wrong or things go south. So what's our margin of safety here? Well, it's actually negative 6.36%. According to this analysis, not only is there no discount, but the stock is actually trading at a premium. For a strict value investor, that's a deal breaker. All right, so we've run Mondelez through our quick Buffett-style checklist. Where does that leave us? Let's pull all the clues together and see the big picture. Okay, so in the pro column, we've got those amazing global brands driving really strong sales. And the company has been a champ at raising its dividend for 14 straight years. But in the con column, we have some serious things to think about. Shrinking profits, that declining ROE we talked about, and a stock price that looks like it's trading for more than it's worth. Now, look, the whole goal here isn't to give you a buy or sell signal on Mondelez. The point of this whole exercise is to show you a framework, a way of thinking like a disciplined long-term investor. So let's wrap up with the big takeaways. 1. Always look past the tasty cookies to the business numbers underneath. 2. Always check if sales growth is actually turning into profit growth, because they are not the same thing. 3. Remember that even the greatest company in the world can be a terrible investment if you pay too much for it. And finally, you can use this simple framework, quality, growth, and price, to start looking at any company you're curious about.
It's just a really powerful way to organize your thoughts and make smarter decisions. So, the real question is, what company are you going to put to the test next? Thanks for tuning in.